What's going on, YouTube? Welcome back to my channel. This is Kevin Jenkins, and today I have another episode for you all. It's called Stock Market Fundamentals, and I want to discuss some strategies that you should be taking long term with your investments and my viewpoint on the stock market. So for those of you out there, I know there's some of you that may feel that the stock market is risky, but I'm here to say that you can definitely build substantial wealth within the stock market over a long period of time by taking minimal risk. You just have to be able to use sound strategies that can give you there and have a plan on how you want to, allocate your money. So I wanted to give you all just some kind of research to start off this episode of some things I found out of those of you that may not be investing, just on some of the highlights of what's been happening in the stock market. So since March 23rd, the Dow has had gains of at least 39.6%. Now this, from research I found out online, was the strongest increase that they seen in a stretch of 50 trading days. And it was crazy to see that since March 23rd, the S&P 500 has gained that amount, because right around March was when the pandemic had happened with the virus, and a lot of people were in panic mode. And another statistic that I had found was, according to Fidelity.com, technology, discretionary, and also healthcare leads were the three main industry leading sectors. Tech, healthcare, and discretionary income. Those are three sectors that has seen growth over the last 12 months. And those were in the areas specifically in free cash flow margins and return on equity. These are usually measurements that you have analysts, different hedge fund managers. They look at some of the fundamentals of these areas when you're doing fundamental analysis on a company. So to see the growth of that over the last 12 months in those three sectors has been tremendous. Also, when I looked at the Dow on March 18th, the Dow was about $18,600. Now the Dow is around $27,000. And that just goes to show you that the market always recovers. So when people were in panic mode in March and a little of April, it just goes to show that you got to tune out the noise, because there were a lot of hedge fund managers. There were a lot of just funding managers and people that had a lot of money that doubled down within the market. And now they're seeing substantial capital gains. Their money has doubled, tremendously since March. So, you can't be fearful when other people are telling you, oh, the stock market is going to go down. The market is always going to go up, and it's going to have periods when it goes down. But when you look at the history, of the Dow and just the stock market in general, the NASDAQ, the S&P, whichever index you're looking at, they tend to create gains over a long period of time, and it always recovers. So, I wanted to talk on, the strategy should always start off with long-term investing. Now, I know I have my day traders out there, and don't get me wrong, the thrive of day trading is real, and it also is very profitable. But at the same time, you can lose a lot of money on the opposite of that coin. And I feel that your fundamentals, your principles, your foundations should be based more on long-term investing instead of short-term investing. Because with long-term investing, what that is going to teach you is having both discipline and having patience. Those are two things that you need in the investing game, and just being able to not be emotional. And I think sometimes with day trading, it can allow your emotions to run a lot higher, because you're trying to make a quick flip, or you're trying to limit your losses. But just understand that I'm using this episode to talk on the fundamentals of the stock market and where your foundation should start at. And I think that your long-term investing play is going to be better than any short-term investment that you make throughout your lifetime. So one thing I say is you want to look at both growth and value funds, and you want to look at these over a 30-year period of time. As far as you want to invest for 30 years, 15 to 30 years at the minimum is what you should be looking at when it comes to a long-term strategy. Now, as you become more knowledgeable as an investor, You will have short-term investments that you may want to dwell in, that you may want to engage with, but learn the fundamentals first. And that's what I want to talk about today. So let's go ahead and let's dive into the conversation. So one thing I did want to mention is, for those of you that may have a 401k with your employer, I always stress and recommend that take advantage of the full match that you have with your employer. So if they match you at 6% with your minimal contributions, make sure that you're contributing 6%. The reason why I say this is because essentially free money on the table. You can definitely take advantage of that free money, and you can still do your own investing on the side, which leads to my next point. I recommend that everyone, on top of what you may already have with your employer, you should also have a self-directed IRA, because with you managing your own money, it's going to be way better and you're going to be way more engaged into it, rather than letting another manager, fund manager, manage your money through your employer, and you kind of call them periodically to see where your investments are standing. But when you really sit down and you take the time to research, you take the time to look at the data, you're looking at, how the investment can grow over a period of time. You're looking at these financial indicators of why it's a great investment. You're doing the research on these companies. When you do that, you're going to get way more out of the investing, and you're going to get way more out of managing your money than letting someone else manage it. So my recommendation, have a self-directed IRA, preferably a Roth IRA or a Roth 401k. Reason behind that is because these are tax-free retirement accounts. So with the tax-free retirement accounts, your money is essentially growing tax-free, and you don't get taxed when you pull it out for retirement. So in comparison to a 401k account with your job, essentially you're investing pre-tax dollars, and then your money is taxed when you pull it out for retirement. So that's the big difference of why it's important to get a tax-free retirement account. And, in general, having a Roth IRA is a great way to structure your retirement account. Now, one thing that I did want to mention is, for the year of 2020, the maximum contribution for a Roth IRA is $6,000. So that's the amount that you can contribute on an annually period. That's how much you can put into a Roth IRA, which is a lot. And when you think about it growing tax-free, you'll have almost double that within a couple years. And now, under no circumstances will I pull from your Roth. The reason why I'm saying that is because I've done it before, and I was penalized and taxed because it was a non-qualified withdrawal. Now, I want to talk on what exactly a non-qualified withdrawal is. Usually you don't have the account for at least 5 years, and you pull it before 59 and a half. Rather, where a qualified withdrawal is the complete opposite of that. You do have the account for 5 years, you're at least 59 and a half. Those are the reasons you won't get taxed. And also, a qualified withdrawal is if you're pulling it out for your first home, or if you have a disability. Now, in my opinion, I wouldn't pull it out under any circumstances, because when you think about it, your retirement account is for you for when you retire, not to dibble and dab in it while you're trying to create wealth. And the mindset of it should be to just contribute to the max every year, max it out every year, and allow it to grow over time. Because, if you have good savings, if you don't have any debt, if you have an emergency fund, you won't need to dwell into your retirement account. So I think that we have to change our approach, on how we invest, and we have to maximize the Roth, because it's a great way to start your financial planning for the long term. Now, I want to recommend some online brokerage companies that you can do research on, that you can look into to start on your individual tax-free retirement account. Some great platforms out there. You have Fidelity, you have TD Ameritrade, you have Vanguard. Now, some of you may start with like Robinhood or Stash when you do your own individual stocks, but as you start to think more of tax-free retirement accounts and looking at creating a Roth IRA, these are great platforms. And, one thing I do want to say about Robert or Stash, that it's a great beginning platform to use when you're investing. It allows you to be able to make simple trades, and it's the whole overall platform is easy to use. Myself, I started with Robinhood, but I eventually migrated to Fidelity. That's who I have now. And the reason why I recommend eventually going to a more advanced, platform, and going to an online brokerage company, because you're going to get more advice. You're going to be able to find more data and research on a particular sector that you may be looking at, a particular index or mutual fund that you're analyzing. And also, with Robinhood, you're not able to specifically call someone to ask questions about your money. Rather than with these online brokerage companies, you're going to have the opportunity to do that. So that's why, I highly recommend it. And it just allows you to do more technical and fundamental analysis. You get the research behind it, and then you can do your own analysis as well. So, that's why I use Fidelity. It's a great platform to, start your investing. And that's who, I prefer to use. Now, some of you may ask, what exactly can I invest with in a Roth IRA? And usually what I would recommend is an index or a mutual fund. It's in a strategic way to be able to diversify your income and your overall investing strategy, and it allows you to be able to spread your risk of a loss as well. Now, for those of you that may not know what a mutual fund is, it's a professionally managed fund that pools investors' money to be able to purchase securities. So instead of investing in one stock with a mutual fund, you may have a list of 25 stocks that you can be able to invest in. Now, an index fund is a fund type that mirrors the portfolio in relation to the specific index. So, such as the Standard & Poor's 500 index. You also have the Vanguard Total Market Index Fund, and a fund's performance will track that of the index. So, a fund's performance is in direct correlation of what is tracking on the index. Now, these type of funds with the index, they're usually passively managed. But mutual index funds are a great way to allocate your money into different asset classes. And that's what I would say use with any long-term investing strategy. It allows you to be able to diversify your income into different asset classes. Now, a lot of funds are also ETFs. Now, what ETFs are exchange traded funds. And this is an index fund that represents the shares of ownership and portfolios of common stock that track a specific index. So an example would be, investing in the SBDR S&P 500 ETF. Some of the current holdings that they have Amazon, they have Google, they have Facebook. I think they might even have Microsoft as well. And for those of you that may not know, SBDR stands for Standard & Poor's Depository Receipts, and they're often referred to as spiders. That's what the acronym is essentially, stands for. Now, for a more sophisticated conversation, I know there are some great strategies towards sophisticated ETFs, and you have what's called a leverage ETF or an inverse ETF. And essentially what that is, you have investors that will try to offset or limit their losses or even increase their capital gains. So, an inverted ETF, essentially an investor is using short selling to be able to move inversely to the market. They're using short selling to move inversely to the market. So they may try to short sell a stock to get a profit, to move opposite of what's going on in the market. So, for example, an S&P 500 inverse ETF is designed to move down 10% when the S&P 500 inverse ETF moves up 10%. So it's moving opposite inversely towards the market. So make sure that you do your research when analyzing the strategy. But this is a lot with fund managers, a lot of head fudging strategies that they'll use to be able to balance and offset some of the losses within, an investment. Now, I always recommend make sure that you do the research on a company. Make sure that you're looking at who the CEO is, looking at how he created the company, looking at his background, his education, his skill sets, his experiences, and also looking at the management teams, looking at what the chief financial officer is doing, what the chief operating officer is doing, really looking at the company as a whole to really make sure that it's a valuable company, because a lot of valuable companies have, excellent management teams. They have, legendary CEOs, people that know how to make moves and know how to move ahead of what's going on in the industry. So make sure you're doing research on that. Make sure that you're evaluating the financial statements. I can't stress the point of making sure that you're looking at the balance sheets of these companies, making sure that they do have cash flows, they do have assets, they don't have a lot of money that's going out to debt over long term and both short term. So making sure that you're analyzing a financial statement and seeing how the company, operates with their assets and liabilities is definitely major. And, I think that another thing that's important is looking at the core values, looking at what the company ethics are. Is this a company of integrity? Are they sustainable investing? Are they socially responsible? Do they give to certain causes in your community? Looking at companies that align with your core values may also make you a lot more interested in that company and learn about what they're doing on a daily basis when you're looking at the research. So that's some of the reasons of, why these are some of the examples of what you should be doing when you're evaluating a company. Now, a great website that I'm going to put in the episode details that allows you to be able to scan index funds and ETFs is etfdb.com. I'm going to put it in the show notes, but it's etfdb.com. It allows you to be able to scan index and ETF funds. It allows you to look at the stock's profile, the dividends, the valuation, expense ratios and fees, and it even allows you to look at the fund's performance as well. So these are all major factors when you're evaluating an index fund. So I'll put that in the episode details. And another thing that I want to talk on is the fear and greed index. It's another index that a lot of investors look at, and it's basically looking at the two primary emotions of why investors buy stock, which is either due to them being fearful or having greed. Now, the logic of the concept is when more people have excessive fear, it tends to draw down share prices. But if it's too much greed, it can also have the opposite effect. So the fear and greed index is a great indicator that a lot of investors look at. I'm also going to put that in the episode details, and I want you all to, take a look at that and really do your own research with it. And just kind of one thing that I want to end this episode with is, just the scripture. Now, 2 Timothy chapter 1, verse 7 says that God has not given us a spirit of fear, but a spirit of love and of power and a sound mind. And just one thing that I want to tell you is that, don't be fearful with just circumstances you may go through in life. Being able to start your own business, being able to be a creator, be an investor, always push and thinking outside the box. Don't let no one tell you that you can't accomplish what you have set out, what your mission and your purpose is. And like the Lord tells us, he didn't give us a spirit of fear. So let's move against fear and move with faith. And, I hope you all, took a lot of the concepts and the strategies that I discussed with the fundamentals in the stock market in this episode. And if you could please like, share, and subscribe, I would really appreciate that, you guys. And stay tuned in. And I appreciate you for watching this video. Take care.